Hello everybody, this is Joe Cusick, Vice President of Wealth and Asset Management at Money Block and Trading Block with your Traders Exclusive for Friday. Disappointing jobs data that came out this morning brought the market down. Now we're off the worst levels in the S&P, down about 13 as I'm looking at the markets, but really this is not a surprise. If you were watching the bond action for the last 2 days, bond yields have been falling off a cliff. And bonds and the S&Ps have been moving in conjunction with each other. So when the bond yields pulled off and the S&Ps were rising, trying to get a last hope bounce and get some upside velocity, well, it didn't come into fruition. One conclusion that can be drawn from all of this activity, which has been, getting people to start thinking about, is this a bear market, is the VIX. If you look at the VIX, the readings that when they remain in the 20s, which they have for almost the last 5 weeks, that means that you have an environment that's much different than what we saw in last October and previously when we've seen that the VIX has come up. And especially, what has not happened is that it did not subside quickly after these spikes that we saw, which was at the end in August. We saw a huge spike. We saw a couple spikes last week, but it hasn't gone below that 20 level. And when we begin to see these large spikes in the VIX and there's no pullback in the volatility, that's telling us that a weakness is starting to get some hold. As a matter of fact, if you look back at the action in the Volatility Index in 98 as well as 99, they both showed that the VIX remaining over 20, that kicked the market to the downside early in 2000. In 2007, you saw that traders were looking at a complacent VIX at around 10. And obviously we know what happened in 08. That really signaled the market top, right? And that's where you also saw early in 2007 or mid 2007 into 2008 where the first spike into 30, boom. That was the summer before. We had the big drop off and then the October top. Right now, this is suggesting a more cautious trade. And so if there is any hope for upside rally, you're going to want to see VIX subside. You want to see bond yields starting to rise. And then you also are going to want to see that the S&P has some new money, some conviction coming in. Otherwise, start putting some VIX exposure into your portfolio. Look at putting either the VXX or the VIX calls and put some sort of strategic approach that will benefit from a rising VIX. It's going to be a very important part of your portfolio. The ratio of VIX to your equity exposure as far as your core is somewhere between, for every $4.50 to $5.50 of equity exposure, you should have $1 of volatility exposure. All right, folks, that's a little homework for you going into the weekend, and that is your Traders Exclusive right here from the CME floor. This is Joe Cusick, Vice President of Wealth and Asset Management at Money Block and TradingBlock.com. We'll see you next week.